Let's perhaps look at the context for a sustainable multi-asset strategy. Do we have this global recovery intact or not? Because it all appears quite uncertain at this stage.
I think the global recovery is still intact, but we are seeing signs of deceleration, which, by the way, we are seeing since a couple of months. It's not just new data coming in, like yesterday, the Purchasing Manager Index for the Eurozone. But, you know, these leading indicators have been on top high levels, so we were expecting some deceleration.
How much of a deceleration, though? Is there any chance that we could slip back into a recession and we could see demand falling sharply?
Well, we don't think that we're going to fall back into recession in the US or in Europe as a whole, but you know, Greece, of course, is in a recession. But if you look, for example, at the yield curve in the US, there are no signs that we are going to fall into a double dip or a second recession.
What are some of the biggest risks that you've identified out there at this point?
Well, the biggest risk, of course, is at the moment the crisis in the Eurozone, but we have also other risks like inflation in emerging markets and the potential for policy mistakes from central banks in the emerging markets. If you look, for example, at Brazil or China, you know, inflation rates are really very high, but we think that given that global growth is going to slow down, and we are also already seeing some slowdown in China, that policymakers will be very prudent going forward.
Do you think there have been any policy mistakes so far? Do you think that they've taken the right approach in China and Brazil, where they've been raising interest rates? Have they been taking the right approach in Europe, where they've been introducing tough austerity measures?
Yeah, if you compare that to monetary policy a couple of years ago in China, I think China, India and Brazil, they have taken very prudent steps, very creative measures to rein in the inflation. So we don't, as I said, we don't think that there is a high potential of policy mistakes at this step.
Well, just given the economic scenario at this point, where we do have monetary tightening in some of the emerging markets, where we have slowing growth coming through from some of the developed markets, what sort of asset classes would you be looking at this stage to outperform?
Yeah, currently, you know, we are, given that the growth outlook is a bit muted in our opinion, we are more or less neutral equity, so we wouldn't overweight equities in a portfolio. But at the same time, we are still very positive on certain corporate bonds, certain high-yield bonds, and bonds from the emerging markets, although we would be more have more of a short duration in emerging market bonds. We don't like, of course, government bonds. We try to avoid every periphery country in Europe with bonds, and prefer, let's say, German bonds over any other European bonds.
Just on your neutral stance on equities, we've come through the US reporting season. We've seen reports coming out of Japan, out of Europe, busy with the South African reporting season at the moment. What sort of quality of earnings are you seeing coming through from companies around the world? And do you see sustainable growth in earnings from those corporates? Well,
we think that, you know, sales growth is still very healthy. Companies in general are very healthy. They are sitting on a huge amounts of cash. But what we expect, that profit margins are going to decrease because of higher input costs, higher capex spending. So we expect earnings coming in weaker and probably causing some deception in the market.
So we could see a bit of a re-rating on some share prices, you're saying?
Yes, of course. And what we are seeing from the analyst community, from consensus, you know, that earnings revisions are coming down. So analysts are being more cautious with future earnings expectations.
Are you seeing any massive differences between different economies with their corporates? So perhaps looking at the United States, Europe, South Africa, emerging markets, anything standing out for you there?
No, as I said, I think you have to be very selective, both in the equity market but also in the corporate bond market. And you probably don't want to own the general markets, so you have to be very active in selecting selecting the different securities.
And would you be going more defensive at this stage?
We are in general a bit more defensive on risk assets, also on commodities. But as I said, you know, there's government bonds are not really an alternative, so we have to be defensive within these risky asset classes.
Are we talking about government bonds globally? Would you be looking perhaps at emerging market debt?
Yeah, of course. We still like emerging market debt. I think the fiscal situation in many emerging markets is way better than in the US or than in many European countries. So we still like that asset class.
And how about South African government debt?
you know, it's part, we look more on a global, I think the problem with South Africa probably is a bit of an overvalued rand from a euro or a US dollar perspective, so we have to be cautious on that side.
And would that go for most emerging markets then? Because we have seen lots of currency volatility, particularly with emerging market currencies and commodity-linked currencies. Is that something that you are taking into account when you are looking at those economies?
Yeah, absolutely. But we think that, you know, many Asian currencies still have potential for appreciation against the euro or against the US dollar. Yeah.
So apart from equities and debts, where else would you be looking at investing cash at this stage? How about cash itself?
Well, we have relatively high cash levels currently. That's because we are somewhat cautious on the outlook currently. We have sold out of some commodities like platinum because we thought that industrial demand from China, for example, is going to slow down. We have sold gold at the beginning of the year, but probably, you know, gold is another good investment right now because all of the uncertainties all around the world.
And is that also influenced by your outlook for inflation globally?
Yeah, although I have to say that our outlook for inflation is, we are not concerned about inflation, especially in US and in the Eurozone. Of course, the ECB already has increased rates one time, but you know, if you look at core inflation, so excluding food and energy, that is very subdued still, also in the US, and the headline rate is basically driven or linked to more or less the cost of energy. And given that the cost of energy should be lower going forward because of lower growth, we expect inflation to come down to normal levels.
Matthias, you're based in Frankfurt, so tell us how you see the Eurozone debt crisis playing out coming from the heart of the Eurozone.
Yeah, well, it's very difficult. You know, of course, you want to avoid all these periphery countries. We have sold out completely out of the peripheries. It's very difficult. We think there will be a restructuring in Greece. There's no other way Greece can handle its debt problems.
And the fallout from a potential restructuring in Greece?
Yeah, of course, that will cause a lot of volatility in the markets, but I think probably investors currently are overestimating the chances of contagion into Spain, for example.